In this interview, I sat down with Enrico, otherwise known as the Rango by our Discord community, to discuss his journey with Darwinex Zero and what it's like being a trader in Darwinian Gold, managing around 650,000 euros at the time of recording. Enrico goes into his journey and talks about how he curates and builds portfolios of expert advisors and why it's super, super important to do so. So make sure you stick around, watch the whole interview, and let us know your thoughts in the comments section below. Well, Enrico, welcome to the Zero Edge. It's a pleasure to have you on, dude. It's one that I've been wanting to record for a while. Obviously, you're quite active in our Discord, and we've got to know each other quite well through texting. So it's an honor to have you on today. Welcome to the show.
Thank you very much.
How are you?
Actually, very fine. Now I think summer is coming, so even happier,
Yeah. So I've actually got a top on today. It's the first time in ages that I haven't had to have a coat on or a jacket, but I guess that's part and parcel of living in the UK, right? So let's jump straight into it. So for the guys in the Discord, they will all know you as the Rango, right? So I feel like we're going to have to put that as a disclaimer at the beginning of the podcast that Enrico is the Rango.
Yes.
Because I always struggle with, I know everybody by their Discord names, and then I completely forget that people have their own identities. But for everybody who's in the Discord, the Rango is Enrico, and I'll be using both terms interchangeably. So let's take things straight back to the beginning. Talk to us a little bit about who you are and how you got into trading.
So my trading journey actually started way earlier than when I joined Darwinex. I think I always had this passion about financial market, also when I was a teenager, because now I'm 29 this year, and it started when I was still in high school. So at 18, 19, I don't know if you don't remember, if maybe you are aware that something called binary option existed at that time, right? And we all know that we all started from there, and to see like how it goes, to just to try out, you make some works during the summer, you get some money, and then you put everything there and you see how it goes. So I started more or less
Put
there
everything in binary options.
yeah, no, not everything, but some, I don't know, 50 euros, 100 euros, just to waste there, and to see if I can win something. But that I realized after years that that was not what we call trading at all, and what we call like professional trading. And yeah, so I started there. I also did my bachelor because I graduated in business administration, and my final thesis was about online trading. So when I did my thesis there, I started understanding maybe a bit more of what is really trading. And then I started studying on my own, my usual books about trading. I read almost, I don't know, 50, 100 books about trading because, I'm very obsessive when it comes to something. So I will jump 100% on the thing, read everything I find online, or maybe on the books, or maybe watching YouTube videos and stuff. So slowly I started discretionary, but I quickly realized that it was not my path at all, because stay on the graph, not 24 hours, maybe 8 hours a day, checking every minute your positions, checking the stops. Uh, it was not absolutely for me. So I started also learning some coding. I started learning some uh, everything that leave me not on the screen, we can say. So when I started also looking around on the website that you can find, I also started coding my own EA without not too much success. So I realized very soon that how to say, it was not really finding the best strategy what it matters for me, but it was more like understanding what is trading for me really about. That I have my own philosophy about that. So for me, trading is not a prediction problem; it's more a statistical game. So I don't find I'm not the one that you will see on the web saying I found this new indicator that will solve all your problems. You know, but it's more like, okay, I have these instruments, how can I apply it to this type of market? So when I started thinking about this way, I also started understanding that I just need simple rules, and that these simple rules can just be coded and let it run on the MetaTrader or whatever platform you need. And from this small thing, I just started creating my portfolio of strategies, and this is how I got into Darwinex, because I wanted to try this new framework, you know. So I started it 2 years ago, and now it is what it is, you know.
So it's been a bit of a journey, really. But what really interests me is that you started while you was at school. Like that's quite
Yeah.
cool, right? How does a teenager find out about? I know you first got into binary options, which I think we can kind of safely say that that was probably a bad decision. But how do you even find out about that stuff and then get so enamored so young?
I think it's because I was a bit of a nerd in high school. So every day I was on the web looking for, you know, stuff that were happening. And of course, now everything that you look, you will find always like a pop-up, this advertisement, like you just invest 100 euros here, and or advertisement, broker advertisement, like open an account on this, trade gold with I don't know, one lot, and gain a lot of money. So I think that was my, how to say, spark of curiosity that started everything. And
And then you
yeah.
said you started out with a discretionary approach, and then fast forward to today, you're now trading fully automated or fully algorithmically. What's that transition period like, and what was kind of? I know you say that it kind of wasn't for you, and you see it more as a statistical game. But where did that switch happen, where you went from making every decision to actually taking a step back and thinking, actually, this is a game of statistics and I just need to play the game as best as I can?
I realized very soon because it didn't work what I was doing. You know, I
Mhm.
lost some money, not so much. Just when you try a new stuff, you're not going 100% on it, but you just need some kind of I don't know how to say, some kind of measure of success of what you're doing, and I was not finding any. I was just, my equity line was just going down, and also if I won some trades, most of them were losing, and like we can say there was no hope on continuing this activity. So maybe I try to look in a different perspective and see that maybe being automated, not even caring about what's going on your account, and having like very simple rules, not over trading, not just looking to enter the trade, but just waiting for the right opportunity. All this kind of stuff made more sense from what I was doing before. So, it's just one morning you wake up and you have this,
Enough's
spark, and you
enough.
say, yeah, enough is enough. What I'm doing wrong? What are all the people doing that I see that are successful? Or maybe,
Mhm.
when you start reading also, you realize that of all the authors that you read, there is always some kind of uh, they are more or less saying the same stuff, not like clearly, but there is a pattern on all these authors and books that put me on the situation that I'm now. So I think, yeah, it's one morning you wake up and you see all your, let's say, failures in one moment, but also that you realize that all these people that traded successfully before you had something in common, and I was looking for this kind of mindset or whatever framework that took me here. So yeah, we can say yes, it's
Mhm.
on
And
one
so,
point, but yeah.
and what's that change like? Like, how did you have any development or coding experience beforehand, or did you say enough's enough? I need to learn how to code, and then I'm gonna go full, 2 feet in, 100%, everything that I've got into automated trading? Or like I say, did you have a little bit of experience where you knew where to start?
So I don't have a big coding experience on my own. So I always use some kind of software. Okay, but of course you have to know what's going on behind the scene, or you're not in control, And I'm a bit say obsessive with control, and I want everything in its place, and if it's not, I'm going crazy. So I know what I'd say an EA is behind the scene, and I also don't want to lose too much time on coding myself because it's very time expensive activity. So I use a software that code on myself. I just say, okay, I want these building blocks, I want it formed like this, and I can also make my test on that software, so everything is way more simple of what if I have to do it all by myself.
I think there's quite a few softwares out there like that, and I mean, as far as building a system goes, it's fantastic, really, because you're only going to be coding. Like, let's say you want your automation to buy at XYZ parameters. You're only going to be coding it the same as it's coded elsewhere. So if it's already done for you, and instead of coding the 2,000 lines in the script for the EA, you just build the blocks together, and it's already done for. I mean, there's quite a few traders who I know who use that framework and are quite successful with it. And clearly, you do the same. Like, I think
It is exactly like that. Absolutely.
Yeah.
I had just some blocks that I just changed the rule or maybe changed some kind of parts. And but the most important thing I have to say, it's not about how it's coded, but how the tests about the strategy goes. Because I can, for me, I'm not. I have to say, for me, it's not about the strategy that I'm using. It's about how it fits on the portfolio that I have now. So also, if a strategy has, I don't know, a horizontal equity line, but it saves me in periods where all the strategies just lose, I will just put it in the portfolio. I don't care too much on the equity line if it fits my portfolio, because I'm not a big fan of one market, one strategy. You know, I'm more. I think you had some kind of strategy improvements on my index some days ago, and you saw that I trade a lot of instruments because I know that it fits more what I think about trading, and I'm not just one instrument, one strategy, and everything goes on that.
Yeah, so you basically, I remember having this conversation when we was on the session. So you essentially use these other assets, because my argument was, if you're trading an asset and you're not profitable on it, it doesn't make sense to be trading it. But your response, which I think was great because it provides another perspective, is you don't necessarily trade these assets to make a return. You use them to hedge a negative expectancy during, like, periods where your main return generators or your main systems will be a little bit lackluster. So even though, for example, if you're trading the Aussie yen and you consistently lose, well, that, even though you consistently lose, it might still hedge when the rest of your assets are underperforming, which I think is a really interesting take, and kind of leads me on to the next question about, you talk about a portfolio. So I'm presuming that your Darwin, which is PGLM, right? Is
Yeah,
that run as a portfolio? That's not just a single strategy, EA or automation. That is a combination of quite a few systems all running under one portfolio, right?
exactly. It's not just one EA that is running on different markets. They are different, and at this time, I think I have more or less 35 EAs running on that index. Of course, you have to be careful with the positions because it requires a big account to handle all these positions for margin requirements. But Darwinex and the risk engine allows me to compete with others also having lower position than what it should be. Just and yeah, basically what I say is, as you know very well, it's not just the game that makes the game. if it actually rhymes, but okay. And right, it's not just the game that makes the game, because you have also risk on the other side, and Darwinex takes very into consideration the risks that you have. So it's not just what you gain, but also how you hedge against your drawdowns, your losses, and this kind of strategies allows me to put in check when my Darwin is getting very dangerous,
Mhm.
and to not have very big drawdowns, and to at least not lose so much if these strategies were not on the portfolio, you know.
Mhm.
And I think this is a very great way to I know, let's say I know that if I put I'd say some weight on these strategies, I will gain less, because of course you have to give some weight on these strategies. But I also know that when it comes to investors, um, they really care about not losing before gaining, you know. So I think I give a lot of importance on these strategies also if they are not very advantageous on my for my portfolio,
Mhm.
you know.
And how do you manage? You say you got 35 strategies running
Yeah.
simultaneously. How do you manage all of them? Like, what does a typical day look like as you, the trader behind the system? Do you have a MetaTrader terminal with 35 windows open that you're constantly looking at, or do you have a routine like every week, every month, every quarter where you sit down and assess how it's performed and if there's any adjustments needed? And do you even make any adjustments?
Of course, if you don't have a routine, I think you will go crazy with 35 AIs, you know. But yeah, I have a routine. Basically, I check my strategies once a month, because I believe that if you start checking every day or every week, I think you are losing a bit the big picture on the equity line.
Mhm.
Because also 1 month, I have to say, is too low amount to judge a strategy based on its performance. I think for me, because I trade almost swing, maybe intraday almost, so my time is very. I have traded last at least sorry, for a maximum of 5 days, because if I have to open a position on Monday, I will close it on Friday, and that's it. I don't have weekend positions, so my range is 5 days at maximum. And for me, checking once a month make sure that I see immediately when a strategy starts to perform way worse than the others, and I can intervene on it immediately, you know. And I check my portfolio and have a judgment on the whole. I think after 6 months I make my checks, and after 6 months, if I see that some strategies are like hopeless, I just change them. Like I just put aside, and maybe I have one other strategy that is just developed, and I just put it on the place of the other. So yeah, this is more or less what I do. I don't lose so much time on checking my account, because I know if I watch too much my account, I'm going to do something that I regret, you know. So I just want to let them run and to do their job without me interfering, because I know myself. I know that if I see that there's too much things involved, I can lose also some of my control, that it's very, against what it should be an automating trading business.
Mhm. Well, you've spent the time to automate it. And then if
Yeah.
you went back in and started
Yeah.
intervening, you're kind of going against everything that you've built. And I also think with that, you can't back test manual intervention either. Like if you're back
No.
testing a strategy, it is pure, raw, and simple. That is what the strategy does. If you start going in and closing trades or adjusting sizing or whatever it may be, you throw all of your statistics out the window, all of the back testing
Exactly.
out the window, and it just
Exactly.
doesn't make sense to do that. And
You are not even able to judge the strategy anymore if you touch it, because you
Mhm.
don't know if the trade that you are going to close or maybe open are part of the statistics that you just you just made,
Mhm.
And for me, like I have a mantra that is like, don't touch everything for any reason at all, because I have the weight of my strategy based on my tests. If I touch them, my tests are gonna be useless. So
Mhm.
it I learn with the time that if you don't have a right, I'd say, control on yourself, you're just going to lose and make it worse. I know that you want to touch it to make it better, but every time I touch something, it went worse. So the experience makes me just stay still and not move.
Which I think
Mm.
a lot of people would struggle with, right? Because especially if you've come from a discretionary trading perspective and you're not just a pure quant developer who's never traded properly, you'll open up that chart and you'll see that your trade's in profit and you'll go, oh, this looks like a reversal here. Should I close it? We're close to target. But like you say, as soon as you click that button, you're interfering with every statistic, every test, every measurement that you've ever done on the strategy. And like you say, even if the trade closes in profit, you don't know whether that's a byproduct of your decisions or if it's actually the strategy that's made that money.
But
Because
you know what I can tell you about this, because I thought about it. I was like, okay, I have a trade that is very in profit. Okay. If I close it now and it goes more, like it goes more in profit, I always think like, is that profit going to save me from losing position in the future? You know what I mean? Because if
Mhm,
I close now, I won't know if that profit will be enough to save me from a drawdown in the future.
mhm,
If I have my statistics right, if I don't touch it, I know how my strategy will behave. But if I start interfering, I start closing the profits. Not you can't control everything, so you have to trust your strategies, and you have to trust your statistics in a way that you know that if it closes that way, there is a reason, and the reason is that you need to let it run to save you from a potential loss in the future. This is how I
mhm,
think. I don't know
mhm.
if it makes sense on that.
Yeah, no, it does. Yeah. Because
So I
you could start closing trades early and not create up enough of a buffer so that when the drawdowns come or
Yeah.
the losing streak happens, you might be break even. Whereas if you'd have let your trades run as your system's designed to, with a positive expectancy, it should be enough to keep you above water and keep you in the green. I follow what you're saying.
And also on the opposite side, if you see a losing position, you I mean, from what I know, I don't have the magical sphere of predicting the future yet, at least. So if I'm at loss with the one trade, at that moment that you just click exit position, it will just reverse, and you
Yeah.
you never know. You never know. You will know only if you let it run and let it does their things. So this is what I think when intervene manually on automating trading. I don't believe that you are going to make it better. I just believe that you are going to make it worse with your positions, and also you don't know where to judge your operativity and where to judge when it finish your judgment and start the EA. You know,
Mhm, mhm.
so it's basically it's like say tweaking your statistic in a way that you don't know, and you don't want to trade in a way that you don't have control of what you're doing. So
Mhm.
that's why I learned on the hard way to just let it run.
And also, I think the great thing for you and the way that it's a little bit easier to sit back is if you're running 35 strategies, even if one has a bad patch, it's not, you're trading with that small size, it's not enough to harm you long term or to worry about really. You just kind of sit back, see, okay, well, has the strategy stopped working? Do I need to do anything? But it's not as if you're trading one system with $1,000 risk per trade, and it's kind of like you need to intervene. It's
Yeah.
a portfolio, isn't it?
Also, if you want, you're not like you don't know where to touch, because with 35, like they say, you just sit back, relax, and enjoy the flight. So you just stay there and watch what is happening. and that's it. And that's why I like to have so many strategies, because also if I want to touch something, I don't know where to touch, you know.
Mm.
So it basically give me confidence on what I'm doing, and also some kind of limit to not touch everything,
Mhm.
to just let it there as it is. And it's also some kind of trading strategy to have all these strategies running on the same time, because they all counterbalance themselves, you know. One will lose, one will win, and if you have a positive expectancy, at some point you will see your equity rising.
Mhm.
And it also I have this thought that I think it's in a good way. I can say that I think that trading in the very short term is more or less random. So also if I have a lot of positions at the same time, okay, I treat it like something that happens casually and I'm not able to predict. But I know that's why I use 1 month or 6 months of judgment on my portfolio, because I know that after 1 month this randomness will go away and it will show me what really a strategy is doing, or how my portfolio is going, you know.
Mhm.
So also this kind of thought helps me to not touch what I'm doing, because
Mhm.
I know that every day, every position that I have is basically random. And on the long term, on the long way, I know that it will reveal of what it is really.
Mhm.
I hope it makes sense,
Yeah, it
right?
does. And you've put the hard work in at the when you was building the strategy to determine what it is going to do and what it's not going to do. Again, you just got to let it play out and look at it like a game of statistics. If you made a bad judgment call when you built the strategy, well, time will tell, but at least it won't have a big enough impact on the portfolio to kill your account. But you've got that leeway, whether it's a month, 3 months, 6 months, where you can sit down and go, well, the performance of this means that we need to remove it and include another strategy or another system or what have you. One of the interesting things about having a portfolio with so many systems is, and this is my question to you, how do you measure the correlation between strategies, and what is there, like any fail safes you put in place so that those two strategies will go too much in one direction on one asset or in one way of risk? For example, if you've got 35 strategies and all of them are long only on US indices, you might have 35 different strategies, but they're all trading the same
Yeah.
correlated assets, right? So how do you combat that?
So the first level of diversification for me is the type of market.
Mm-hmm.
So you won't have me having like 10 strategies on your euro dollar, for example. You don't have me having 10 strategies on Nasdaq, or I don't know, whatever index you want, or whatever instruments. So for me, at maximum, I have 4, maybe 5 strategies on one instrument, you know. And this is the first level. Then I go deeper into that, and for every market, I have like the type of strategy that I have. I have a couple of breakout strategies, a couple of mean reversion, and usually I know that more or less when the instrument is trending, I know that the mean reversions are going a bit, you know, worse than the breakout. So more or less, the first level is about what the market is doing. Then the second is what the strategy is doing, and third level is how are the statistics of the strategy compared one to each other. It means like if a strategy enters a lot, or maybe it has bigger position than the others, I know I will weight the strategy a bit less to compare more or less all the strategies at the same level. We can say that I'm making more or less the same as Darwinex does with all the Darwins, but I'm making it on a portfolio level. So I just put every strategy at some level of risk, and then I weight them basically on how well they are doing, or how much risk they take, how often they enter a trade, or something
Mm-hmm.
like that. So I have different way of diversification on my portfolio, and as you can see, if one strategy completely fails, it doesn't bother me too much because I have other 34 or 40 strategies that counterbalance that. But the correlation between the strategies will be always a problem, because you can say, yes, I have Nasdaq, 5 strategies on Nasdaq, and I have 5 strategies, I don't know, on Dow Jones. But we know very well when one of these is going down, also the other will follow at some point, right? And as long as you, let's say, as much, let's say that based on your strategies, also if they are very different from each other, you don't really know at what extent your calculation of correlation will hold, because you can have like a strategy that gains more and it's not correlated to another, but when bad times come, you don't know if this correlation still holds, right? So it's always like some kind of you suppose that the correlation will just stay, or we just don't stay, and you just hope that these different strategies act differently of what the market is doing. But you never know. It's like predicting the future, you just know what happened on the past. You never know what will happen in the future, so you can just trust at some point, at some level, this correlation will just disappear, and you will just say on, I'll say, you will just lose, and that's part of the game. Your only way to control it is just to check if these strategies are staying on the statistics that you just put, and that's it.
And how do you, I mean, this is kind of going more of a broader approach to how you trade or how you build a system. What's the process when you decide either a new system needs to be included or replaced with something else? What's the phase by phase to developing a new system? Do you put it into a concept where you play around with ideas, then you play with actually putting the blocks together, testing, and then maybe back to square one? Or do you have a very rigid approach where you go, I have 5 mean reversion, 5 trend following, 5 breakouts, replace one with the other? Like, what's that process like for you?
So we all know that trading strategies are a scarce resource. So when you find something that might work, you want it to explore and to develop as much as possible to see if it really fits what you are trying to do. So at first, I just started with I don't know, reading online some ideas, reading forums, or reading also books about some kind of strategies. And if you find something can fit your portfolio, you start developing, you start doing some tests, and you start trying strategy for, I don't know, to back test it on just a small period of time. This is what I do usually. So I just use, I don't know, 3 or 4 years, and I see how it goes. If it has some potential of becoming something good, I start testing on a larger period. I start testing a different situation. I just start, for example, I'm developing a strategy now on Nasdaq, and I'm trying it on just the last 4 years, for example, and I found that it is a good strategy. So I started developing also Monte Carlo simulations. I start tweaking the parameters. I start understanding if it holds a very difficult period, like, I don't know, last 2 months for me were a bit stressful, because with Trump, everything was going a bit, bad, at least for me. And also during COVID pandemic, how it goes in the situation. And all these kind of tests makes me build the trust that this strategy will perform good also on the real market, because we can say that putting a strategy on real is the last step. It's really the last brick on what you are doing. All the job is doing before putting on the account. So I always take 1 month to test it to understand how different parameters are, how different situation, how different markets also this strategy perform. And if passes all these tests that are more or less, I think I have some kind of protocol that I follow. So I do step by step, and more or less I have 15 tests that are this strategy has to pass to be eligible to enter the portfolio. It's like a job interview for strategies, you know. So if they don't pass all this, I will just throw it away and start new with something else.
Yeah, and it's interesting. It's very similar to I recorded an interview last week with the Darwin IME, and you two have a very similar approach. And he said exactly the same thing about testing, and we kind of come to this conclusion where it's better to throw away a dead system and kind of say bye to the time wasted, because every minute that you spend trying to optimize or develop a system that's just never going to work, it's taken away the time from building something that actually is going to work and actually would be able to fit into your portfolio. But it's just interesting for me because everything that you're saying today, I keep relating it to what Blaine was saying, and it's exactly like you said at the beginning. You know, success leaves clues. All of these successful people are saying the same thing, and you've just got to try and dig through all the fluff to get to that point. And that's exactly how I feel between speaking to you and speaking to Blaine. Is I'm noticing a pattern between all of our successful traders, and you're all doing the same things, and it's all super interesting for me because I'm learning a lot, especially when it comes to algorithm trading. Hence why I'm asking so many questions about it. I'm trying to pick
Maybe
your
you
brain.
are entering the gang, right?
I am. I mean, I have some coding experience, but I've been using again a software like you where you just put the blocks together. I think it helps understanding to a certain level a little bit about code and playing with that sort of stuff. But it's a great way to get into it, in my opinion, is using these softwares, because you can build a system in 20 minutes. Of course, the testing takes longer, you know, as long as you've got the logic in your head of what you want to apply and stuff.
You were saying about optimization, right? Some time ago, and I have a very nice take on that because I think I will be very, how to say, judged on that. So what I think about optimization is that most of the people, when it comes to it, they are doing it completely wrong or what is supposed to be. For example, when we think about optimization, I don't think that I have to find the best parameter from that strategy, right? But for me, finding the best parameters is to find an area of parameters that works. Do you know what I mean? Because
like between X and Z sort of thing, you don't have to get it precise.
because what I do with my strategies, I don't optimize them in the classical way. For me, I have to say that I'm not interested on the parameters of the strategy or what the parameter the strategy is using, because one of the tests that I do is called the system parameter permutation, and it's some kind of let's say it's some kind of statistical test that takes all the parameters that the strategy can, you know, take, and it puts together in a distribution. And this, it shows what is the average of the performance based on all these parameters. It doesn't show which parameters makes this performance, but just takes all the parameters and make it an average or a median. And that is my first sign that if a strategy performs well, it shows that more or less 70%, 80% of the parameters makes a good performance. I'm not interested in the single parameters. I'm interested on the I'd say on the very big range of what the strategy can take, what parameters the strategy can take to perform. Okay. I don't know
Yeah.
if it sounds complicated, I don't know if they made it
I
complicated,
know
but
exactly what you mean. You're looking more at the average distribution than just trying to optimize for a single asset on a single time frame and getting it as good as possible.
it's like I'm not interested of that parameter, like in particular. I just interested that also if I tweak a bit the strategy on a different one, I know that if the strategy is robust, it will perform anyway. Okay.
Yeah.
This for me is optimization. It's just finding an area of parameters that basically performs more or less all the same. So also if I put a parameter that's a bit different from what the original one is, I'm not worried about performing way worse or more or better, So when it comes to online forums, I always read that yeah, you have to find the best parameters on that market. You have to find this one and that one. But for me, doing something like this, it's called overfit. And when I have an overfitted strategy, I know in advance that it's going to lose a lot of money because it doesn't work. It doesn't work. It doesn't hold the real market. It just performs well in a back test. So this is, I think, if you want to optimize a strategy, you don't have to look for a single parameter. If you look just for a single parameter, you are going to lose a bit yourself on the process because it will take a long time. And also, it doesn't form a robust strategy that holds the real market. That's it. That's my take.
So if you're performing the test where it's looking at the average distribution, do you then take kind of the medium, the average, and use that as the parameters for the system?
I use the parameters that put me on the center of that area of results.
Yeah.
So you can see, like, if you let's take, I don't know, a moving average, for example. From, I don't know, we have a 30 period moving average to 70 period moving average. If I have a strategy that has a moving average on the indicators, I don't know, and has this parameter, I backtest the strategy from 30 period until 70. I look for a stability area on that. And if I see if the results are more or less similar on that area, I just take the middle parameter and I put it on the market. Because I know if the market acts a bit different of what the parameter takes, what the movements of the strategy takes, I know that more or less, if it changes a bit, it will stay more or less on the same statistics, and I'm able to predict, I'm able to weight the strategy on the portfolio, I'm able to to have some kind of trust that also if the market is a bit different of what the backtest was, it will perform more or less on the same. So this is very important, at least for me, because it gives me some kind of ground to based on my risk management practices, to understand how much to weight a strategy and how much it will perform on real market. And we all know that we can't predict what will happen in the future. And this, at least this process for me, gives me trust on the strategy and give me trust also that it will continue to perform in the future.
Yeah, because you're taking, instead of trying to look to get it to the best possible performance that you can, you're looking for the more accurate data. Okay, what is more likely to translate into
Exactly.
future results? And when I put this system live, I want to know somewhere in the middle of worst case and best case. I don't just want to know the best case scenario.
Exactly. Because the best case scenario is just an overfitting parameter. Because the best case scenario is just the best parameter that you find for that period of time. But it's very unlikely that the same conditions will hold also in the future. So if you, let's say this, let's say that we have a bag full of little balls, okay? And you know that for some kind of, I don't know, balls, you have some kind of results, and for others, you have other results. You have this very beautiful white ball that it's on the bag. And if you have 100 balls on that inside this bag, and you know that this white ball performs way better than the others, okay, but you don't know, this is your best parameter for the strategy, but you know that the other 99, okay, gives you some kind of results, and these kind of results, okay, are going to be way more likely than the white ball results that you will have, you can try to pick up, right? And this is what for me are the parameters. It's more likely to have some kind of results on the big spectrum of parameters than to have the big results on just one parameter, you know.
Hmm.
It's a statistical game. You are not betting on the make the jackpot. For me, you are just betting to have a decent performance, and this decent performance is more likely to be there instead of just the best of the best. You know, I prefer this approach than to just try to hit the moon. We say,
Hmm.
you know.
It's an interesting perspective because everybody always says don't overfit a strategy, make sure you don't over optimize it, but nobody's actually given the insight of like what you just have in going, we'll find the average distribution and just kind of use that as the benchmark. You want to know the
Yeah,
systems performing in all market conditions under any parameter, as opposed to taking a losing system, just fitting it exactly to the parameters it needed for the past 5 years and hoping that it works in the future. The only
exactly.
question I have off the back of that, because you was talking earlier about, you know, going through the different tests, and you'll look at a strategy over a 5-year period, then you might take it to a 10-year period. At what point do you, or do you even give any sort of recency bias to any data? Because, and the only reason I ask this is because we know roughly before 2015, the volume of algorithmic trading was significantly lower. The retail percentage of the market participants was significantly lower. And if you go back any further, like, my point is, in my opinion, there's no point backtesting a strategy that you've coded on data from the 90s, because the market is completely different. So what's your kind of cutoff point where you would go, well, between 2010 and 2015 it didn't perform well, but from 2015 to 2025 it's year on year it's done 2% a year or 3% a year, solid system to add to the portfolio? Would you ignore the 2010 to 2015 because it's had 10 great years, or would you still kind of take that into account?
It really depends on the strategy, because for me at least, you have like some, let's say, like for example, Bitcoin, it started to perform well and perform at a decent, at least for me, of what my operativity is. It started performing well from 2021, and before that, it was not very, let's say, the condition that I like. And for that, I always use a different market to test the strategy. It means that also if as your example, if it didn't perform very well before 2015, but I see that the performance is still good on another market, or another two markets, and can hold also all my tests that I'm doing on the strategy, I will still take into consideration that strategy, because I
Mm.
see, and I've seen that also in other markets, especially, and in other conditions, it will just still profitable, you know. So I'm
Mhm.
not very into, okay, if it didn't perform well on the last 20 years, I'm going to throwing out, you know. I'm more into, okay, the backtest is just an instrument to understand how the strategy behave in some kind of conditions, and then if it has a decent results, I will just put it in real market. Because honestly, yeah, I was doing that at the beginning. Like I was just taking, last 10 years and that's it. But with experience, I prefer to just take the strategy in different tests and not care too much on how long ago it will start performing worse or better. So I prefer doing tests on parameters, for example. If it has a big range of parameters that this strategy works, I will take into good consideration. If it performs on different markets, it performs on very interesting situation like COVID pandemic or Trump administration and all this kind of stuff. But for me, if you want a benchmark on that, I think the last 10 years are a must to try the strategy if it's
Hmm.
possible, of course, because for
Hmm.
Bitcoin it's a bit difficult and also
Of
for
course, yeah.
cryptos, you know.
Yeah, but I think 10 years on commodities, indices, FX pairs, you kind of get a good, and
Yeah,
markets do evolve, right, with like more efficient executions. As I mean, we forget that what 20 years ago, they like the retail trader was kind of not really a thing. You know, electronic trading had only been around for a few years at that point, most likely. So it's the markets are always evolving, and sometimes data can be a little bit misleading if you're testing it on stuff that's not really
yeah.
accurate. But I guess the past 10 years, 2015 to 2025, that's probably, like you say, it's an absolute benchmark. You need to know the performance over that period.
Yeah, but the length, I think, of the back test is a bit misleading, because, for example, you have a strategy that makes 20 trades in 10 years. It doesn't make sense. Also, it's not just the length of the back test that matters to me. It's very a different kind of parameters or statistics that makes all the whole picture. You know.
Mm-hmm, mm-hmm.
So it's very complicated to just say, okay, I take this amount of years. Or it's interesting also to, a lot of people have different opinions on how many trades you consider a strategy like significant, with statistical significance. Because some people say, okay, I'm fine with 200 trades. Some other people are not very calm with 2000 trades. So everyone, you can have more opinions than people really on this matter.
Mm-hmm. Yeah, but you've ultimately got to figure out on kind of a discretionary basis per strategy what the best or most optimal way to test that one is. For example, like a Bitcoin strategy, you can't test that and optimize that the same way that you would a euro dollar strategy. It
Of
just
course.
it you kind of have to look at each individual system and figure out what's my MVP, what's my minimum viable product or minimum viable test that I need to pass this specific strategy. And it's not going to be the same between two. Again, if you've got a daily time frame system compared to a 1 minute, it's of course the 1 minute is going to take way more trades. So maybe a year's worth of data on that system is better than 10 years on the daily,
Yeah,
you know.
exactly.
And those are the kinds of things that you have to take into account, I guess. But you've been trading for about 10 years then, right? Maybe just over 10 years. If you're 29 this year and you started as a teen.
Seriously, the last 3 4 years, very seriously. Like, because I started my Darwin, I think 2 years ago, like
To
really 2 years ago, because yeah, it's turning 2 years this month.
yeah.
And before that, 1 year. So we can say, yeah, 3 or 4 years, seriously.
Okay. And so what initially brought you to Darwinex? Had you already got your portfolio figured out? Like was your goals the same as they are now? Or like what attracted you to what we offer as a company?
So let's say that before Darwinex, of course, like every trader was looking for a good prop trading firm to join, you know.
Mhm.
So after some, we can say, scams, after some very bad companies, I was looking for something more serious, something that I can rely on the next 10 years. And I was looking on Darwinex also because this kind of uh, Darwin framework was not very common.
Mhm.
Actually, it's not very common now, because I think there's no other companies that does the same. And I was looking to the website. I was seeing like, okay, I see that some people are really having some investors. I can see that they are giving capital allocation by themselves. But the fact that I started with Darwinex Zero and not with the Classic, and I was looking into Darwinex also even before joining Darwinex Zero for a couple of years, and I saw that you had your requirements, your capital requirements, you have to have like more than 1,000 euro. And if you want to have something interesting, you have to start for at least 10,000, 20,000 euro that I didn't have the possibility at least 4 years ago. But when it started with Darwinex Zero, I saw immediately the opportunity to join because you had like a real broker finally behind the platform, and also the opportunity to spend $40 I think every month, and to be on the same level as Darwinex Classic with investors capital at some point, and with the capital allocation from the platform. I saw that it was very big opportunity, so I just jumped as soon as the program started. I think I started after 1 month or 2 months,
Mhm.
right? I don't know. I think you started in February or something.
In
I don't remember.
2023.
Three,
Yeah.
two, yeah. And yeah, after 2 months, I joined immediately. I saw the platform was fantastic, and yeah, and that the rest is history, I think, right?
Well, the interesting thing about you is that you saw it that way, because I have this conversation, as you'll know, being in the Discord, where I feel like the prop industry has intoxicated a lot of traders' brains to be super short term and want everything straight away.
Oh
And so
yeah,
I have this constant battle with traders saying, well, I want to be paid out tomorrow. I want $1 million under management tomorrow. I want this, I want that. And I'm like, you're only thinking that way because of the prop industry. And if you'd have worked in professional finance or traditional finance beforehand, you'd understand that these things take time. And you're a testament to that, in that you've been with us for 2 years and you've paid that subscription fee for 2 years. But now you're managing $260,000, I believe it is, as of today,
yeah,
in investor capital. And then, oh, I can't even remember what your Darwin, it takes you up to about 500 in total. You got 538,000 euros.
yeah. Hmm.
So $260,000 of that. It always confused me because the investors is in dollars and the Darwin is in euros. Let me pull it full screen so I'll be able to actually see the amount. So you got 305,000 euros in Darwinia allocation and $264,000 in investor capital. Now,
Correct.
it's taken 2 years to get there, but that's $500,000 in AUM that isn't just going to be gone tomorrow, even if you have a drawdown patch.
Exactly, exactly.
You know,
But
and
the problem is that I don't want to make, I don't know how to say in English. It's like I don't want to make fun of myself. Does it make sense? I know that this kind of things takes time, and also if you want to have a benchmark, and to see how well you are performing against other people, you see that making the objectives that the prop firms are asking for, it's a bit like it's a dream,
Mhm.
because if they're asking for like 5-10% on account every month, when the best people are doing it in 1 year, you know it's a bit, how can you even like think of being able to be sustainable on this kind of rhythm, you know
Mhm.
so when you think about it, I mean, my conclusion is that maybe there's something wrong on this kind of environment. Maybe they are forcing you to do something wrong so you won't pass the challenge and stuff. And maybe just maybe, I'm not saying anything. Maybe it's just a way to scam you, and to just give money that is not a part of your job, but is just some kind of scheme that gives you back. Because I know that Darwinex is a regulated broker, so the money doesn't come from the clients; it's backed by the market itself. So this is what I say. And also, I know that 15% performance fees is low, but you are not there for, you know, the money that you receive is part of investors' capital, and you don't. It's not your money what you're
Mhm.
trading. It's investors, and you know that if you want to be paid well, you have also to perform well. And the most important thing is that investors, let's put it this way, I'm not performing very well on these 3 months. Okay. And investors are still there after 3 months of very low returns. In a prop firm, this doesn't happen. If you go bad, they will close your account and they will cut all your contact with you. You know,
Hmm.
maybe they will ask you to repeat the challenges and stuff, but they don't. They don't trust you. You know, and Darwinex, I think, is some kind of different because you have big numbers that comes into your Darwins if you are performing well. We can see THA, for example, that manages 20 millions, maybe more, right?
Hmm.
We can see real numbers and real money going around on Darwinex. So for me, it was like I'd say, a dream come true to manage other people money. Also, uh, by myself,
Hmm.
with not no rules, and you can use whatever you want. You are free to trade. You are really uh, trading the way that you want and not what other people are telling you. This
Hmm.
is what I prefer about that.
Yeah, I mean that's what trading is, right? There's
Yeah.
the rules, the drawdown rules, profit targets, all of those sorts of things are artificial parameters put in place
To
to
make you
you
fail.
like they say, and I don't want this to sound like we're full on attacking the prop firm industry, but equally you can't put numbers in like that are artificially generated and say it's performance based, because we know even the best traders go over 10% drawdown sometimes. So are you going to reject the world's best trader just because they've had a larger drawdown than the 5% per day or the 10% overall? It doesn't make sense. Whereas, and I guess I kind of want your thoughts on this, is with prop firms you kind of pay for your funding, and if you're lucky enough to get it, you've then got to keep it. Whereas I think with Darwinex, the model's more of a meritocratic approach, so you earn your funding. If you and I are both traders at Darwinex Zero, we pay the same subscription, we get access to everything the same. If you earn it more than I do, you get more funding, you get more investors, you get more Darwinian allocation, you might get Darwinex Labs investing to you. So what's your thoughts on having that meritocratic approach to trading as like a competition with all of the other Darwins? So you're in competition with 10,000 other Darwins, but if you perform well, you're the one who gets the capital.
But you know what's the best thing I think about Darwinex? And some people will just say, no, this is not true. It's the risk engine is the best thing. I will show you why on on this take. Because when you trade a prop firm account, okay, you don't know if the trader, you don't know how much the trader is risking to do that 10%, right? So you can be lucky, I don't think, for 1, 2, 3 months, and you think that that trader is the best of the world, right? So on Darwinex, you put everyone on the same level, and on that same level, when someone performs better than the others, that it's just not luck, but it's actually some kind of advantage.
Mm-hmm.
So when I also look from an investor side, if I want to go in a place where they are a bit, they are hiding something, they don't show you everything, I would be scared to put my money on that person because I don't know the full story.
Mm-hmm.
And on Darwinex, I know that all the people are put on the same level. I know that the one that are performing better is because they are better and not just risking more. So I'm more like calm, and I can trust Darwinex more about that the money, especially my money, will come back at some point and not disappear.
Mm-hmm.
So that's a very good point for that. And I see maybe some people don't see, but a lot of people are putting money on Darwin. Almost every week, I have someone that puts, I don't know, 1,000, and other people put it back, and there is movement on that. Maybe because after 2 years, okay, I can have enough, yeah, track record to attract something. But at the beginning, it's very hard to see that, especially if you are starting like in 1 month, 2 months, because
Mhm.
how can you trust someone if you have just 1 month of track record? It's like I'd say playing head and tails, okay, having 5 heads and see that you are good at the game. It's more or less like this for me. So it's
Mhm.
better to have a very long track record and to work on that, and you will see the results 100%.
Mhm. Yeah, rather than just kind of a random distribution of winning trades to
Exactly.
or a winning period. It's kind of like and again, going back to your point where everybody's risk adjusted to the same level, is it's kind of, changes it from a sprint to a marathon, and it's
It changes everything.
who can run the furthest, with the same gas tank, right? Who can keep doing it for the longest period of time, as opposed to, I mean, you'll be gobsmacked at some of the messages that I receive where people will be like, I've doubled my account in 3 days, but my Darwin's only done
But
0.1%
that is
return. And I'm like, well, there's a
yeah,
reason for that.
that is casino, is not trading. It's
Yeah.
like just betting on red and then hoping that 3 or 4 times you are getting lucky.
Yeah.
That's it. There's no way to explain that. At
Yeah.
some point you will just burn all your funds, and that's it. You start from zero.
And it will be gone. And just
Yeah.
the problem is, again, going back to the prop industry, I think it's made it feel okay to do that, because if you blow up an account, it's okay, you can just get another one and all is forgiven. Whereas when
All
you,
is
like,
forgiven.
yeah, yeah, and in
That's it.
your case, you've built up a record for 2 years. That's way more precious to you than anything else, because you don't want to burn that record and start from scratch. And it's a completely different mindset. I think you have
Exactly.
to be
And I
wired
can take
completely
that
different.
track record, I can take that and it will remain there forever.
Hmm.
There's no way I can delete, I can't text, Darwinex, say, this is very inconvenient for me. Just delete, it doesn't work this way. So I can also show to investors in the future, look,
Hmm.
I'm able to be consistent for 2 years without, failing, without changing too much on my trading style, and it works.
Hmm.
So it's the most important thing, at least if you want to manage more than 10,000 euro, at least on
100%.
an account.
Yeah, 100%. I completely agree. And so let's wrap it up with one last question. If what would you say to a new trader who's thinking in the long term, they've got all the right mindset. What do you think their approach should be in their first kind of 6 months? Like, how do you think that they should set themselves up for success for the long term as a trader?
Do you mean on Darwinex or in general?
You
In
tell me.
general, you tell me. Okay. So I think the most important thing that you should work on the first 6 months is about the process that you're going to create or maybe develop to build a portfolio or a strategy. Because you have to know that going on real market is just the last thing that you have to do. Okay, all the hard work is done before entering a position, you know. So
Mhm.
I think the most important thing to take care about that is just don't think about choosing the right broker for you. It's about creating a process that it will allow you to create strategy that you trust, because it's very good when other people will sell your strategy and says, okay, this will take you from zero to the stars, that's it. But the most important thing is when the things are going bad, if you don't trust your strategy, you are going to do very wrong things. So the best thing is when you don't trust your strategy, you are going to close your position yourself, maybe, or maybe um, tweak the parameters that are not the one that you build the strategy on. So it's very important that you create a process where you are 100% sure that when bad things happen, you are there and you don't do anything wrong with your strategy. I think this is the most important part on the first 6 months on the process. And then on Darwinex, I want to say that 6 months, as you will see, it's not even the minimum track record for gold. And I think it's good to be your last problem to be in gold. You just need to have a consistent result on your track record, and then if you are like a good trader, gold is just a consequence of your activity. It is not something that you have to make it the goal of the journey. It will be just a
Yes.
consequence on what you are doing.
I absolutely love that. I love that point, because I always say to people, again, you won't believe the amount of times I get asked by people, I've got this, should I stop trading, or I need to get to gold, so this isn't, and I'm like, just focus on trading. Like you say, if you are good and consistently good, gold is a byproduct of that skill. You don't have to force it or change your behavior. It doesn't make sense to change your approach to hit a target. Like it literally doesn't make sense. And I couldn't have put it in better words than you've just said there. It is just a byproduct of you being a good, consistent trader.
Exactly. Because if you are forcing yourself, I think you're just going to fail. I can't say it more clear, because it really is what it happens, because you're forcing yourself in something that you can't control. You're going to do something wrong 100%. There's no if, there's just when. Right? So just think about doing the right thing. The results will just come, and you will just enjoy it at the moment that you will achieve, and that's it.
100%.
There's no secret sauce, it's just simple stuff. But
the secret sauce is stick to a process and just let time do its thing.
Yeah, exactly. Because also I want to say that I'm not when I put my portfolio on real market, my first thought was just to control, to not lose so much, not how much I will gain, but how much I'm willing to lose before saying stop, that's it, I'm done.
Yeah.
Okay. And the results, the gain is just, if you have good strategies, it will come eventually. There's no, it is like this. I know it's difficult to think about it when you start, because you don't have experience that things will go the way that it should go, and it's very simple to just stay in a vicious cycle and to not achieve what you want to achieve, just because you want to control things that you can't. So that is what I want to say.
Yeah, I love that. Dude, I just want to say a massive thank you for coming on and doing this session with me today. I know we had a little bit of a last minute hoo-ha. I was for anybody who's watching this and knows or watches my usual content, you'll notice this isn't my usual background. My internet's down, so I had to come to an office, and I was texting Enrico when I was at the reception desk because they wasn't letting me in. So I didn't know if we was going to get this done today, but we've made it happen. Rango, Enrico, it's been an absolute pleasure to talk to you, dude. And I just want to say on behalf of all the viewers, like, we're all rooting for your success. You're a huge part of the Darwinex Zero community, and I wish you all the best for the future.
Thank you very much for having me.
Awesome. It's been a pleasure, mate. You look after yourself.